Hello, and thank you for joining us for our latest Finovate webinar. My name is David Penn, Research Assistant with Finovate. Our presentation today is called Unlocking Open Banking Data, a Masterclass in Cash Flow-Based Underwriting. Leading our discussion are Mike Wimmeyer, he's CEO of Tactile, Abhinav Swara, he is the VP, Head of Credit Risk with Bluevine, and Jonathan Gurwitz, who is Credit Lead at Plaid. Before we get going, I want everyone to know that this is an interactive presentation, and we're looking forward to fielding your questions toward the end of our presentation. So if you do have one, go ahead and leave a question for us using the Ask a Question button on your module there, and we will go ahead and take as many questions as we can toward the end of our presentation. I also want to let everyone know that we welcome your participation by Twitter, or by X, I guess I should say. So if you want to join in the conversation on X, feel free to do so, and just use the hashtag FinovateWebinar. So we've got a lot to cover and not as much time as we'd like to cover it. So I'm going to go ahead and get us started. To do that, we're going to first briefly introduce our panelists, and then we're going to jump right into our first question. So maybe starting with you, Jonathan, could you please just introduce yourselves briefly and maybe just tell us a little bit about your roles at your respective companies?
Yeah, no problem. Hi, I'm Jonathan Gurwitz. I lead go-to-market strategy and execution for our credit business. At Plaid, focused on building kind of products and solutions for lenders and folks with lending use cases. For a bit of context, Plaid is a data network that powers over 8,000 apps and services, including fintechs like Venmo and SoFi, several of the Fortune 500, many of the largest banks in the country. In the credit and lending space, we support use cases across the loan life cycle, so everything from cash flow underwriting to income verification, identity verification, payments, and a whole bunch of other use cases. And then in terms of my background, I've been at Plaid for about 2 years, spent the prior 5 years at Credit Karma, helping to lead our personal loans business. And prior to that was building consumer credit products at a neobank called Varo.
Interesting. Let's have Abhinav. Maybe you could start next. Just a little bit about yourself.
Hi, I'm Abhinav Swara. I'm the VP and Head of Credit for Bluevine. I joined Bluevine maybe a year ago, and then prior to that, I have like close to 15 years of experience across companies like American Express, Capital One, doing various credit strategy roles and building credit products. A little bit about Bluevine. We are basically a financial services company lending. We have a lending business and a checking business. Over the last 10 years or so, we've lent close to around $15 billion to small businesses. And today I'm excited to be here chatting about cash flow underwriting because that's something that we leverage in order to serve a variety of businesses across the credit spectrum.
Yes, as we were talking about before, that's a really exciting space. It's starting to open up a lot of interesting things going on there. Mike, maybe you could finish this off. Just introduce yourself a little bit and tell us about the work that you do at Tactile.
Thank you, David, for having me on the show, and thank you for hosting us today. So I'm Mike, co-founder and CEO at Tactile. Tactile is a software company. We built a risk decision engine which helps fintechs and lenders and banks to make better risk decisions. So we sit between data providers like Plaid and fintechs like Bluevine or Abhinav is at, and we help the risk teams to iterate on the credit policies and connect the most modern data sources to their credit policies and models. And that's why I'm super excited today to share some of our learnings, talk about the potentials, talk about the challenges in cash flow-based underwriting. Myself, I've been in risk for the last 8 years, building a risk consultancy before Tactile. So I've been in the weeds for many, many years, building statistical models and risk models myself. And now we're on the software side and equipping the teams that I was in before with the right software. I just moved to New York, relocated here 3 months ago, and we located our office in the American Express Tower, Abhinav. So you probably know that building quite well, where I'm sitting at right now.
Fantastic. Well, I definitely think we've got the team for this topic today. Let's go ahead and start with you, Jonathan. We were talking before about how there really isn't a way for people to really get a very good sort of gestalt level understanding of what's going on with cash flow underwriting. And I wonder if, Jonathan, maybe you could start us off with maybe giving us an understanding of how cash flow underwriting has evolved over time, maybe sort of a brief history of cash flow underwriting, so to speak.
Yeah, I'll try my best. I'll kick it off with a premise that cash flow data and cash flow underwriting kind of more generically have always been important to lenders. I think often lenders think about the world as being able to underwrite an applicant's ability to pay and their willingness to pay. And I think cash flow data really hits at kind of the ability to pay component to it. I guess pre-open banking, and so we're talking north of 10 years ago now, the challenge was collecting that cash flow data. And so for an applicant to share their cash flow data required sending in or emailing or uploading PDFs of bank statements that a loan officer, then needed to manual review. The process was time intensive, it was costly, it's prone to manual error and fraud. And so kind of given some of the friction in the process, I would say, again, pre-open banking, we're talking here, it probably took a backseat, at least in the consumer space, to traditional credit data. Now, I think things are really changing and evolving, again, over the past decade with the acceleration of open banking. I think it really shifts and evolves the experience, both for lenders and their applicants. So on the lender side, lenders are now getting kind of digitized cash flow data where they're able to build out granular insights and attributes that look at inflows, so income, or if it's a business, revenue coming into the account. They're able to look at a detailed view into expenses, ultimately trying to get at free cash flow and that challenge of ability to pay. So I think that really enables much deeper risk evaluation. On the applicant side, the process of sharing that information and permissioning that information is also much easier. So instead of uploading docs, it's now a process where you can link an account within 10 seconds many times. And then if you think about the overall experience and interplay between lender and the applicant, because of this kind of highly efficient process, lenders increasingly are able to auto decision folks. So instead of having them apply and come back later for a decision, being able to auto decision ensures that you're creating a really efficient experience for your approvals and kind of keeping them moving forward in the process. So we see a ton of opportunity going forward to continue to scale cash flow underwriting and support lenders' diligence of ability to pay.
Very interesting stuff, and I want to stay with that a little bit and stay with you too, Jonathan, for my next question. You gave us a nice example of some of the ways that cash flow data underwriting has sort of really revolutionized what's happening in credit writing with the example that you just provided. I wonder if you could expand a little bit more about that, both in the B2C and the B2B context, maybe with more additional examples of just some of the ways we might see some very exciting changes in. And Jonathan,
maybe
start with you.
Yeah, maybe I'll kick it off with B2C, and then I'll pass it to Abhinav for the B2B side there. I've always liked watching the personal loan space. At face value, it's a very simple product. It's an amortizing installment loan, but some of the innovators, the fintech innovators in that space, have taken distribution of that product and put it online, which actually is a relatively complex thing to do. The ability to get someone an approval for anywhere from up to $35,000, or in certain cases even higher than that, is a challenging thing to underwrite and kind of do fully in a digital context. And so some of the players in this space, again, online personal lending, marketplace lending, I think the space has evolved quite a bit over time, were some of the early pioneers in the use of cash flow data. They had a challenge in that kind of consumer experience where, again, to make a loan of that scale, you are going to want to verify the user's income. And the process of doing that often was very challenging. It involved manual doc uploads, it involved things like calling employers. And so what they found is by leveraging open banking and enabling consumers to permission their data, they're able to evaluate the direct deposits coming into that account and assess whether what the user put on their application as stated income checks out, create a much more efficient experience for the applicant and the process overall. And so that's really exciting. I think That has evolved over the last, again, decade or so, where we're now seeing players in that space actually think about how can I not just use this data at the point of income verification, but how can I actually use it in the decisioning process? Use this data alongside credit bureau data to make a better decision. And so thinking about folks that maybe you would have declined without the incremental cash flow data and seeing kind of trends in the primary checking account, being able to kind of turn those into an approval. Or alternatively, if there's folks that you may have given a weaker offer where you might see lower accept rates, being able to improve that offer. So I'm really excited about kind of that space and kind of the opportunity for cash flow underwriting in the consumer space more broadly.
Interesting. And if we can maybe take a look at the B2B side. Abhinav, if you wanted to talk about that, perhaps?
Yeah, and maybe I'll building on what Jonathan said. Like if I was to look at the space of lending to businesses maybe 10 years ago, and look at a typical credit risk model, I would say most of the value is driven by your credit bureau features, which we all are familiar with. I think 80% of the value in our models would be coming from credit bureau features, and a little bit will come from your applications and the data you would collect. I think over time, with the leveraging cash flow based underwriting, I think that mix has changed dramatically. I think right now it's close to 50-50, and I would say even sometimes, depending on what segment you operate, it is probably 40 or 30 credit bureau, and a lot is coming from cash flow underwriting. And then the other thing I would say is if in past, most of the high line lending and B2B spaces, lot of loans are made. The needs of the customer are actually to get larger loans. To lend, a traditional lender would essentially go through financial statement based lending, which again is a little bit. There are certain challenges around it being very manually intensive. The access to financials is there's less automation or digitization there, although traditional banks have worked towards it, but the process is still very, very cumbersome. Somebody has to upload their financial statements. There are questions on whether how accurate they are. They can be easily manipulated sometimes, so they're not necessarily always reliable. But having access to cash flow data, banking data through open banking platforms like Plaid and all, I think has basically reduced that cycle time, and digitally the customers can provide the bank statements very quickly, and our underwriting has become much faster. Our ability to actually lend at larger loans to meet businesses' needs has actually significantly improved. At Blue Wine, we over the last 10 years or so, we've obviously built some of the foundational infrastructure for these underwriting models, and that has actually helped us lend to two segments, I would say, which otherwise would bigger banks would not touch. There is a stat that internally we had done a study in the last 3 years that we have lent to approximately around 40% of our lending has been to minority businesses, and that would not have been possible through if we were just purely using the traditional data sources like credit bureaus and all. So we definitely believe and have witnessed the potential of cash flow data, and we continue to innovate. I think the opportunity is huge here, and I think we've just started with this. I think there is a lot of opportunity for other lenders also to adopt, not just fintech, probably for larger banks also to play a role in this space.
Very interesting. I'm curious your take, Mike, as you've mentioned before, sort of being in the middle between these two groups. What are you seeing from your perspective in terms of the capacity for cash flow data to really revolutionize what's going on in credit underwriting?
Yeah, let's maybe, if I think about the opportunity and potential of cash flow based underwriting, I would probably talk about 3 buckets there. The first one, which has also been mentioned by Abhinav and by Jonathan, is that the classical scores, bureau scores, they're not always really representative of the probability of default of their customers. So take it for a consumer or for a business. For a consumer, me as an immigrant, I'm moving to the US. I don't have a good credit history, so I don't look good, not good at all in my credit score. So if anyone in the audience is a consumer lender and you receive an application from me, please don't reject me. Just ask me to connect my bank account, and I tell you, I'm probably very credit worthy, hopefully. But yeah, it's an issue. It's an issue for many. So it really makes a big difference there. And the same for businesses. If you look at Tactile, it's a young company, and when we raised our Series A, we got $20 million in the bank, and we're not burning that much money. So very easily you can do the math. If you have $20 million in the bank account and you're not burning that much per month, we should probably get a term loan for a year or two. However, what happened is that our credit score, even from a business perspective, was so bad that when we wanted to get leasing bikes for our employees, we get rejected. It was like a $500 leasing bike, and they rejected us, and we had $20 million in the bank. And stuff like that just cannot happen. But if they would have connected our bank account, they would have seen the money we have and how much we're burning, and I'm very sure a company like Bluevine would have accepted us for a small thing. So so that's one thing. The second thing is really for me real-time data, and the big power there for open banking is you do see data very much updated. So in consumer, what Jonathan said in the beginning, you want to know if someone gets a job. What's about the salary slip? Are you still employed, or maybe you just got promoted? If you get promoted, I want to be the first one as a lender to offer you a new financial product. But at the same time, if you lose your job, I really want to know what's going on and see if we can get you back in financial health. And for businesses, many of our customers are in the B2B space. And if you're an e-commerce store, same thing. If your sales are going down, and you can see that in open banking data by how much do you spend on marketing. If you're not spending anything on marketing and your sales are going down, you really should react very fast as a lender. So, for me, the pulse of a lender should be the financial health of its customers. And the financial health is very well represented in transaction data. And maybe to finish up for me, the third one is, the full financial picture that you can get of a business. So the same thing for a consumer, you want to know what's the affordability of a consumer. And by knowing exactly on what buckets I spend my money on, fancy stuff, not fancy stuff, I get a very good understanding on my affordability score. And so overall, I think these are the three buckets where I see great potential for open banking.
Excellent. I want to talk a little bit more about the ways that and strategies that have been used to integrate the data, or build specific strategies using cash flow-based underwriting. And I wanted to maybe ask each of you sort of your various experience, maybe starting if you have enough, in terms of any strategies that you've seen work particularly well at Bluevine using this cash flow-based underwriting.
I think I would break that down maybe into I think what all you need to focus on when you're thinking about developing your own cash flow based underwriting models. I think the three buckets in my mind are how do you integrate and consume the data from the customer, right? And this is a little bit dependent upon your every individual company's acquisition strategy. And then the second is, once you have that data, how do you go about interpreting it, cleaning it, storing it, and consuming it into your underwriting models, essentially. And then the last one is that how do you sort of create your own feedback loop around whatever you interpreted as the cash flow data, because you're trying to derive intelligence from whatever you're reading in the transaction data, and then you have to over time improve that. And I think there has to be, it's needless to say that there has to be a feedback loop, but I think given the state where the state of how the transaction data is, there's a lot of need to actually make sure that you are continuously monitoring that your interpretation of that data is accurate and continuously updating those models. So I'll talk a little bit about that, maybe double click on each of these buckets, but let me start with what is the integration part, right? So I think specifically for us, Bluevine as a B2B lender, our acquisition strategy involves asking the customer, the channel, based upon the channels, we try to push customers to connect Plaid, and based upon that, their entire experience can be very digital, and we can get the information around banking and transactions very seamlessly through Plaid connection. But there is also a segment which actually prefers to provide like manual statements downloaded through their own accounts and all. And we do entertain that. So depending upon what your acquisition strategy is, you may have a slightly different mix. But right now, whenever we get manual statements, we have a slightly different process of actually reading using optical recognition, character recognition to actually read that transaction data and then consume that into our model. So I would say preference obviously is to leverage as much as you can through Plaid, but you got to think about depending upon your own model, like what additional things you need. Second bucket, I think, forms, which is around how do you derive intelligence out of the data that you're seeing. I think that forms the bedrock of your underwriting framework. We have invested over the last, I would say, 7 to 10 years heavily in actually developing intelligence around like the transactions that we are reading in the banking data. What do they mean? Does an example of that would be that if you are seeing a bunch of transfers into somebody's accounts, that could either mean that they are the question is like, is this a legitimate revenue source, or they are just trying to get money? Two people are just colluding to actually inflate the revenue or inflate the cash flow into the account, right? So all of that is more of like over time you develop intelligence by developing across accounts and like linkages, and that's just one example. Other example is like we see a lot of inflows into bank statements around loans that the customers may have from other lenders. Now, I would say a lot of lenders are very standard, so you can learn. You know that they have loan from other lenders, but lenders are continuously getting added, so the list keeps on growing. So our models may not recognize that as a lender. So there's a huge difference between counting something as a revenue source versus a loan that you may have, right? They are interpreted differently in our model. So it is important that you continuously invest in making sure that these transactions that you're seeing in the banking data, those are accurately tagged so that you can have the right estimate about customers' revenue, customers' true sort of ability to pay and all, right? So and then the third thing I would say is like the intelligence around fraud. Cash flow data is not immune to like I would say artificially manufacturing transactions. Two people can very easily collude, or a group can easily collude to show inflated cash flows. So we invest heavily in actually making sure that we understand that very well so that we can protect ourselves from fraud. So I would say that's an area where we have traditionally, these are the few buckets that we've traditionally thought and created a lot of models around that. And then the last point around the feedback loop is, as I said, if your lenders list is you're continuously seeing new lenders come into the market, if your bank statement, because some bank changed their format or the transaction tagging description changed, etc., you gotta have a mechanism to actually adapt your transaction tagging models. Plaid helps with that quite a bit, but if we have like a statement sort of a model, you want to make sure that you have some sort of a manual human element to make sure that the tagging is accurate. So it was a long answer, but hopefully that gave a little bit of clarity around what are some of the areas that we focus on to continue to make sure that our cash flow models work effectively.
Yeah, clear and comprehensive, both. You mentioned Plaid, and that it makes me want to turn to Jonathan. And Jonathan, in terms of how lenders are using Plaid to derive signals and such from cash flow data, are there examples of that you can talk about from your experience with lenders of Plaid?
Yeah, happy to share more kind of around the capabilities that we deliver that help our customers analyze the cash flow data. Abhinav, was really exciting to hear kind of the boots on the ground, kind of lender perspective there, particularly in the business lending space. But kind of at a higher level, I'll walk through kind of the tooling that we provide, I'll start kind of with the most basic and kind of move into increased insights and support. So, of course, I think most folks are aware we provide kind of the overall account linking experience that enables capturing kind of the raw data. We focus intensely on coverage, quality, conversion, all of the key things that are critical there. The next piece, as we think about layering on insights and support, is the categorization component. So the way these transactions come in, there is kind of a transaction identifier, which is not always the easiest thing to parse through and understand. And so we apply kind of detailed categories to those transactions. We spent a lot of time iterating and evaluating and updating those models and ensuring that we've captured the right categories that are kind of lender and credit specific. So thinking about capturing inflows, income, thinking about capturing outflows, key expenses, and kind of getting a granular perspective. And what that enables lenders to do is build custom attributes that pertain most closely to their business and the underwriting they're looking to do. The next step I would share is we do have an attributes library where kind of we share logic with customers, and that helps, again, get another step up on that process of kind of transforming the raw data into actionable insights that kind of support underwriting decisioning. And we work closely with our customers in that regard. And then the last piece, we did announce earlier this week that we've launched a CRA entity from which we'll be offering kind of out-of-the-box insights. And so we're really excited about that as a path forward to be able to deliver our customers, insights and predictive attributes that will help, again, our customers get to market more quickly, get more value from the data, and ultimately make it more efficient from an investment standpoint in terms of supporting your overall cash flow underwriting infrastructure. So we're really excited about that.
Very, very interesting stuff, and very interesting news earlier this week that we covered on the Finovate blog that you mentioned with Plaid and the CRA as well. Very exciting stuff coming from there. Mike, I wanted to turn to you and talk about what's going on with Tactile and the lenders that you work with who are using cash flow data. Are there any unique strategies that you're seeing at the moment that you think might be worth sort of adding to this conversation?
Yes, I would love to touch up on two, but maybe first of all, Jonathan, congrats on the launch. It's been perceived very well, also across our customer base. Many of our customers are using Plaid, and they're really excited about what's coming up. So congrats on the launch. I think if I look in our customer base, two strategies that are really, really obvious and also what we've seen to be very powerful. The one is all around data cascading. So what is data cascading? Data cascading is the optimization of using external data in a consecutive way to make the most accurate and cheapest and frictionless risk decisions. And how does that work? I mean, the most accurate one, every data, if it's like a credit score, if it's cash flow-based underwriting and so on and so forth, brings a different type of signal in order to predict the probability of default for a certain customer segment. So just saying I want to use all data for all customers just doesn't make sense. You need to learn for which type of applicant which is coming in, you want to have which kind of signal. So having there a mix between cash flow data, transaction data, but also bureau data, or let it be HR and payroll data, or let it be for B2B accounting data. The mix in the end makes a good policy. And then it needs to be cheap. If we could pull all data for all customers in the world for every applicant, that would be wonderful. But it's just not feasible. So you need to make sure that you only pull the data for the customers that actually you're sure of that they're creating a good signal. So if I know I have a prime customer coming in and the FICO score is good enough, it's good enough. But then you really want to make sure you triage in a way that customers you would normally reject, then you actually use a connection to a bank account and start using their data to have a prediction which is above the credit score. So, but yeah, you need to optimize for cost. We're all interested in unit economics in times of high interest rates. So really making sure ordering that in the right way is important. And then third part of that strategy is making very frictionless. We will also talk about challenges later, I think, David, and just a sneak preview there. Not all customers always want to connect their bank account, but really making sure you do it in the most frictionless way to increase acceptance rates is also important. Tell people you would be rejected right now with our current model, but you could connect your bank account in order for us to reconsider you. And we've seen very, very high acceptance rates in the past. In order to how do you formulate that to which type of customer segment? So data cascading is one strategy. The second one, which I found to be very interesting and very successful, is the share of wallet. So understanding how much of the spending you actually see in that bank account. And we've had that in the past. We are a customer of a big spend management B2B credit card company in the US. At some point in time, they called us and said, well, how can it be that you don't have any spend on cloud infrastructure? You're a tech company. And I said, yeah, sure, we have it on a different bank account. And then their sales team upsold us and we put our 50K AWS bill per month onto their credit card. So if you know about the share of wallet, I think what Cashflow actually enables you as a lender is not only thinking about it from a risk perspective. So don't only think about what's the probability of default. We all know Cashflow can be powerful. However, also think about it more generally. Don't think about PD, but also think about the LTV. Think about the lifetime value of a customer. And you can see a lot of things in that data about the lifetime value of the customer. And you should use it as a lender, in order, to use it for your business operations. In the end, we need to earn money, and that's a great way to use that type of data.
Yeah, those are some excellent examples, and I do appreciate that you previewed sort of where we're going to move to in the conversation. We've talked so much about the opportunities with cash flow-based data-based underwriting, and there, as we say, they're legion. But we know there are challenges and there are hurdles as well. And again, Mike, you tipped off a few of them. I wanted to turn for this part of the discussion first with Jonathan to talk about the issue of the infrastructure for cash flow-based underwriting and talk about some of the different challenges that have been in the past, and then perhaps maybe some sense of some of the things that Plaid has done to maybe optimize that infrastructure to make it easier for folks to take advantage of this cash flow data.
Yeah, happy to jump in there. So we think about kind of the challenges, or perhaps more optimistically, the opportunities here in really two buckets. One is what I'll call data availability, and that is how easy is it to actually get the data itself. The second bucket is data usability. So conditioned on you actually getting the data, how easy is it to operationalize it in your underwriting process? And so on the first piece, availability, this has been really kind of the core focus of Plaid, which is ensuring it's highly efficient for applicants to permission their data for these types of use cases. So at this point, we connect into north of 12,000 institutions across banks, investment accounts, payroll connectivity, et cetera. So we're really excited about that. We spend a ton of time thinking about and investing in further developing and reducing friction in that process of account linking. So that's certainly been a focus area for us and for kind of the broader Plaid team. I think the second piece is where we're really doubling down right now around usability. And again, once you have the cash flow data, how easy is it to operationalize? I shared earlier kind of our announcement earlier this week around forming the CRA entity to tackle that problem of usability and ensure we're providing out-of-the-box insights that customers can leverage, of course, alongside kind of their own attributes and insights. So we're really excited about kind of our next step and kind of driving forward and supporting customers on the usability side. I think the other piece I would share on the usability side is ensuring that the data is integrated in the platforms that our lending customers are using. So platforms like Tactile and other platforms, ensuring that it's readily accessible for building into their decisioning. strategies and models. So that's a bit on the context around kind of how the key areas of challenge and opportunity and how we're focused on scaling.
Excellent on that critical infrastructure point. I want to turn to Abhinav, if we could, and talk about some of the challenges that you might have seen, again, coming from the perspective of Bluevine with regard to, again, cash flow underwriting. And of course, importantly, what are some of the ways that you sort of helped some of your customers overcome some of these challenges?
Yeah. I would love to answer. There are a few, and I'll start with one, and I would want maybe Jonathan's reaction on that. And this is less of like so maybe the context essentially is that when we request customer banking data is permission data, right? So you need customers' permission. Often when you connect through Plaid, the login needs to be provided, et cetera, right? And which is great. Most customers in our case actually do provide us when we request, but there is an issue in terms of connectivity. Like, given the power in banking data and the fact that you can access real-time information to continue to update your models is extremely powerful in customer management, right? However, if I lose the connectivity because of whatever reason, because certain banks do not allow maybe the connection needs to be refreshed every 3 months or something like that, it becomes challenging for me to have an insight into the real-time insight into what the customer's latest status is. And the challenge is like both from a lender perspective as well as customer perspective, right? From a lender perspective, if I don't have the latest information on customers' financial health, I may, if I'm conservative, I may take an action in terms of not lending in future or taking an adverse action on the customer, right? We try to mitigate that by reaching out to the customer, requesting them to reconnect, etc. But it does not always work that effectively, right? So I think we have some mitigation, but it is not very, I would say, effective. And I want to hear Jonathan's views also on this. I'm sure this has been brought up, but is there any kind of thought, because this is probably a bank issue versus like a Plaid issue, but curious to hear your thoughts there.
Yeah, first of all, I'm encouraged by hearing kind of the value of the data across the loan lifecycle, which I think is what you're sharing, which is not just at origination, but on an ongoing basis as you think about delivering more value to that customer. So I think that's really exciting to hear. I think the second piece is, how can we continue to scale what we call persistence, like the persistence of that connection. And that's kind of an evolution that we've seen in open banking in general. So as our integrations and as our connections increasingly move towards API, we're seeing increased stability. But that evolution does take time, right? It requires building infrastructure and connectivity. And I think we've been, in many ways, the pioneer there, but there's more work to do. So we'll continue investing there. But I think getting lender feedback around the value of the data and the value of maintaining that live connection is really helpful as we think about prioritization of our efforts.
Awesome. That is great to hear. But as just reiterating, we find tremendous value in that connection because we want to give customers line increases in future, and to protect ourselves also, we want to use the real-time information to take any negative actions if we need to. The other challenge I would say, moving from this one is again a little bit, I think Plaid's becoming a CRA will address this, is the lack of probably like complete standardization of the data. As Jonathan talked about, that transaction data is Plaid invests a ton. We on top of that, we also invest a ton to further develop insights. But I think if there is a lot more standardization that happens at Plaid's end, more and more lenders essentially end up benefiting, and we have to invest less in the second layer of deriving more intelligence from. I mean, we'll always have the second layer of deriving intelligence, but the attributes that we get from Plaid, if they are way more standardized, I think we will benefit more. So I think as any new lender, if they go into this exercise, I think that becomes a significant adoption challenge in the beginning, which they have to continuously evolve over time. Yeah, I think those are the two. There are obviously experience-related considerations that people should think about. Cash flows can be volatile. This is less of like a problem in terms of adopting cash flow underwriting, but more of a watch out that if you start using cash flow underwriting, you should always keep in mind that, especially in the business space, cash flows can be volatile. So you don't want to overreact to the volatility. But obviously you have to be mindful of like not making too many negative actions on the customer if you see in 1 month their cash flows are down versus the other.
Interesting observations there. Again, the idea of the volatility of the cash flow, that sort of it giveth, but one does have to be careful, even with such valuable data source. Mike, again, you had sort of previewed our conversation about some of the challenges and hurdles. You've heard a few of them shared. Are there a few that you'd like to add to that list of things that you think that lenders in particular need to be careful about, or at least consider when looking at cash flow data and cash flow database underwriting?
Yes, I think Jonathan Abhinav did a great job talking about the main hurdles. I think we know about in the community: data availability, connectivity, people having multiple bank accounts. I think the last point that Abhinav just mentioned on, I think would be interesting to double click into, as we have like in the audience, the risk community here. And like there is an infrastructure, of course, challenge, but I think the very interesting piece is around the risk knowledge, what you just called experience, Abhinav. Like even if you've been in risk for 10 years, you have just very, very little experience on that kind of front, because there are not that many lenders and companies that have been using cash flow data for underwriting consistently over time. So like it's very, very interesting to really sit down there with our customers, and people are saying, okay, great, now I got the connection to Plaid, and but what do I do with it now? So like, what are the right, Jonathan, you call it insights, I call it risk signals that I actually should be using for my use case, for my product, for my customer segment. And how do I weigh that? Like, should I take the last 30 days of cash balance on the account, last 60 days, 90 days? I don't know. It depends a little bit. Like, how fast should I react? And I think that's one of the things, a challenge where there's not too much knowledge in the risk community, but that's also gives an opportunity to differentiate from your competitors, differentiate from other lenders in the space. If you are the ones who like crack it faster, I think you can really drive profits, which has not been possible for some years, where a lot of things are commoditized in lending. So I think that's super, super cool. The question is, how do you do it? And there, for me, it's all about like fast iteration cycles and very good, back testing simulation. It's one of the things where, it's hard from an infrastructure perspective. Like, do you have, a decisioning infrastructure in space that allows you to do that, but really making sure that if you have the defaults, what would that change? What would that insight signal, risk signal would have done on your portfolio if you would have like applied it in that way to customers? So, good back testing would be my advice there to the audience, and then rolling it out, fastly iterating, checking it, changing, checking, iterating. And then it actually, you can close that knowledge gap fast by really learning on the fly with that new type of data.
Very, very interesting. We're coming up on our final question, and I wanted to make sure that our audience and attendees knew that they do have the opportunity to ask questions of our panelists. That you can make a specific question to one of the panelists, or if you want to have it to the field, so to speak, that's okay. We are getting quite a few questions in, so if you do have one, we're going to try to get to as many of them as we can. But if you do have one, now would be a great time to get that fired in there. And again, we're going to have one more question that we're going to present to the panel, sort of a larger look at some of the opportunities in this space. Then we're going to go ahead and move to some of those questions. So if you do have a question, please go ahead, use that Ask the Question button, get it in there. And again, we'll try to take it up as soon as we can. So to that end, let's go ahead and this is again a question for the field, so to speak. Sort of looking at this entire landscape of open banking, cash flow data, what are some of the opportunities you see for really innovative lending products or services? And this could be for B2B or B2C, depending on your perspective, that you think might be around the corner as some of the things that we've talked about, some of these hurdles are overcome, some of these opportunities are really seized. What are some of the things that you're kind of looking forward to? And Mike, we'll start with you. Just to get you right here.
Yes, would love to. I keep it short to have enough room for questions from the audience. So for me, it's twofold. The one is using AI for what in that sense. It's for me for really like the categorization of transactions. Abhinav, you said you've built a lot of stuff in-house. Plaid is, of course, built a lot of things, but like we have also at some point in time we had 15 working students at Tactile just labeling transactions in order to come up with the right labels or like categories for transactions. And lately we tested how accurate a prediction of LLMs like ChatGPT were in comparison to that. Very, very, very similar. So I do see a huge kind of like efficiency gain there. At the moment, caveat, these APIs are very expensive. If you like pull 1,000 transactions for a consumer loan and you send them all one by one to the OpenAI API, it's going to be too expensive. But if the price comes down, I see a huge opportunity there. Second one for me is regulation. From Europe, we have PSD2. Every bank needs to expose their data, their bank accounts to the public. In the US, it's not quite there yet. Companies like Plaid are solving for it. But I hope that at some point in time, the US regulator will also make banks kind of like liable to expose the data, and it will make things easier in terms of data coverage. So those are my two future wishes and opportunities for cash flow-based underwriting.
Excellent. Jonathan, yourself.
Yeah, I'm really excited about, and I think Mike brought this up earlier, this idea of kind of progressive or second look decisioning flows becoming more mainstream. I think, as I shared earlier, we've seen cash flow data be used really effectively on the consumer side in income verification and increasingly in decisioning. And I think there's these exciting opportunities to kind of work the data into the decisioning flow such that, when, upfront you might be collecting your traditional bureau data, your applicant info, you're able to, place the, applicants or consumers in 3 buckets, right? Like there's the folks you can automatically approve because they're super prime and you feel good about them from a risk perspective with traditional bureau data alone. There's folks that are outside your eligibility thresholds, and that you're going to need to decline them. And then there's kind of, let's call it a pending population, where you can present the opportunity to share their cash flow, and in that situation, it's kind of giving the lender an opportunity to capture an incremental approval. Or alternatively, maybe it's a consumer that you're going to give a relatively weak offer to, but you have the opportunity to improve that offer and capture a higher accept rate. And that kind of sequencing in kind of the origination process and the decisioning flow, I'm excited to see how lenders tackle that and innovate there.
Excellent. And Abhinav, your thoughts on, again, some of the future we might see in terms of underwriting and potentially really innovative products and services around the corner?
Yeah, I want to second what maybe Mike said earlier. I think I do believe that AI, in terms of labeling, is a huge area for innovation. We spend quite a bit of time there. I think I would prefer not to spend that time. So if somebody can solve that problem, I think that would be great. And then the second one I would cover is a little bit slightly maybe something that we haven't talked about is fraud, right? I think personally, I feel like losing money on credit can be managed because it is predictive and you price for your credit risk. But when you have fraud and especially when you have like manufactured cash flows, transactions, I think the severity of those losses is very, very high. And we are increasingly seeing like customers learning that what they need to do to manufacture cash flows, and they're becoming harder and harder to catch over time because fraudsters are just one step ahead all the time. So I think like more products on that side, I do think there is value or innovation that can happen there by actually understanding I would say account linkages at different individual levels, who is moving money across. If you end up seeing like more like sort of ring phenomena, people transferring money from one account to the another in a combination of rings. We try to do that quite a bit internally, but I think our data set is what our data set is. Like a larger data set can help catch that even more effectively. So innovation there would be very useful.
Very, very interesting set of responses. We've got a few questions here, and we've got about 10 minutes, so I'm not sure if we're able to get to them all, but we'll do our best. Here's one that came up, and whoever in the group feels like they really want to respond to it most is fine. This question asks, are there any legal ramifications of having that real-time data access over the life of the loan that you faced? Did you mitigate those with additional disclosures to the borrower? The question on legal risks with regard to rate data.
I'm happy to take that, and I'm not sure if I might not get that fully right, but I think our disclosures already cover that we have sort of say the right to connect to the bank account. I think the to get the real time data access. So we do that when the customer signs up and all. The challenge that we end up facing is like the bank connections. And I think legally, because we added to our disclosures, we are kind of covered there. There might be some other risks that can be that are there, but I think as long as we're covering it in the disclosures, we are fine.
Did anyone else want to touch on that, or do you want to move on to the next question? Okay. Here's one that's a little bit complex, but I'm going to go ahead and give it a shot. Let's see. In the realm of challenges to cash flow-based underwriting and open banking in general, do lenders run the risk of relying too heavily on cash flow data? And this is something I think we've all touched on to some degree, in terms of versus traditional financial benchmarks and so forth. This person is saying from their experience at different fintechs, these factors always tend to take a back seat when the cash flow information is prioritized, which both opens additional risk and also prevents other product opportunities and limits origination amounts. And this is something I think you've all addressed to some degree. So if you want to maybe respond more directly to this question, that'd be great.
Love to give my view on that. So I must say, from what we see in the market, I could not agree on that. We don't see that much. So like right now, the lenders and fintechs that are using cash flow data for underwriting are very much more on the sophisticated side. People normally, like if it's your balance sheet or your debt facilitator, you don't try it out and throw out the money. So kind of like a disregard of those kind of factors into risk models, I would like put in a very, very inexperienced team. And normally those very inexperienced teams, I have not seen really using cash flow-based underwriting. So I wouldn't agree on that. What an advice would be there for in terms of strategy is, run just good A/B test, roll out the new policy to like 5, 10, 20% of the portfolio and see how powerful it actually is, how predictive is the data. And if it's predictive enough and it's very cumbersome or expensive to buy the other data sources that the person from the audience mentioned, traditional financial benchmarks, you can take them out at some point in time, maybe. But I would argue that most credit and risk teams are advanced, sophisticated enough to not go too risky in the first place there.
I just want to add one thing there. I think, and Mike covered the risk part. I think the risk is probably less as long as the teams are cognizant. I do want to say that given like the weightage of how much cash flow versus traditional data sources show up in your model can vary quite a bit with economic conditions. There's some study done by that I recently saw in Wall Street article as well. I think there was a comparison of FICO versus like cash flow, and that has changed over time. And I think that as risk teams, we need to be very carefully watching that. That is not to say that cash flow will not add value. It's just that as underwriters, we got to be closely watching what is adding value to your model, which is regardless true, not necessarily a point for cash flow or the other data sources, but generally we should be very closely watching what data source is adding, and that can change over time.
Yeah, and I'll just jump in quickly there. I actually think that a lot of the lenders we work with are looking to the cash flow data for signal on some of the key macro trends that are currently ongoing. And so when you think about, in the subprime space, how higher gas prices or higher inflation more broadly are affecting kind of consumers' budgets and their savings, how, restarting student loan payments, obviously you can see the payment amount on a traditional credit bureau, but to see how it might stress a budget, I think having cash flow data available there is helpful. And again, when you think about these factors collectively, like when are you going to see potential stresses sooner? Like, I guess if you look at a traditional credit bureau, it's a bit of a lagging indicator, as valuable as that data is. When you start to see delinquencies, when you start to see missed payments, it's based on these monthly reporting cycles, as opposed to starting to see real stress on the cash flow data flowing through. So, I think it has been kind of a more real time and valuable source of macro factors in this highly uncertain environment we're currently living in.
Very interesting point. Yeah,
that was a very. We're coming up near the top of the hour, so we don't have a lot of time. There's one more question that came in. There are quite a few questions that came in, but there's one question that came in that I'd really like to see if we could just squeeze in right quick with maybe some short responses. And this has to do with, do you think that cash flow-based underwriting will open up credit access to small, medium-sized business? I think that's kind of a huge topic for, obviously, for small, medium-sized business, but for fintech as a whole. And I'm wondering if that's something you think is the case. And maybe just take a quick round around the panel with that one. Will cash flow-based underwriting open up more credit access, in your opinion, for smaller and medium-sized businesses?
Happy to give a very short one. I would say that's a 10 out of 10. I very, very, very much agree. I mean, for consumers, there's already quite some research credit scores out there, and they're not bad. I think for businesses, there's so many underserved small business owners in the United States, and it's just a very hard problem to solve. Like accounting data, financial statements is something which is self-reported. It's very slow. It's not up to date, and like having a direct access to revenues and cost of a business is so powerful in terms of signal for lenders. So I do see a lot of opportunities opening up there for small business owners, but on the same time, it's a bigger market for lenders as well.
Yeah, can't agree. I think at Blue Wine, we are already seeing that and doing it. So we lend to medium and small businesses, and I covered this stat at the start of our call. In the last 3 years, 40% of our lending has been to the underserved, and quite a bit of that overlaps with the small and medium-sized businesses.
May I ask one quick question there, Abhinav? Is it for you, when you say SMB, it's small, medium businesses, like some are very small, some are very, bigger. Which kind of like segment size of company you see the biggest success there with cash flow-based underwriting?
So generally, I would say our sweet spot is basically anywhere between half a million to 3-ish million. That's a huge range, but generally that's the kind of range we operate in.
Interesting. Thank you.
Excellent. Well, again, I want to thank you all for your insights today. I want to thank all of our attendees and the folks in the audience for being a part of our presentation. Thank you for your questions. Again, our apologies if we were not able to get to your questions. We had more questions than we usually get, I'll be honest, with webinars. So this is really kind of nice to see that kind of reaction, to see that kind of participation from all of you out in the audience. That is all the time that we have today. Again, I'd like to thank our guests. If you have any feedback for us about our Finovate webinar here, there will be an opportunity to complete a short survey at the end of the presentation. So please stick around and let us know your thoughts. We do read them, and it does help us make new presentations in the future that much better. So again, thanks for joining us. I know someone in the chat asked about recordings of this webinar, as well as other webinars that we've done for Finovate are available or will be available on the Finovate blog. So be sure to check out the Finovate blog in the days and weeks to come for access to recordings of this and some of our other webinars. So again, on behalf of Finovate, on behalf of the research team, thank you to our guests, Mike, Abhinav, and Jonathan. Thank you for joining us, and have a fantastic day.